Hallak from Andersen and Michael Pereira from KPMG, two of Canada's leading cross-border tax experts. Namir is a Vancouver-based CPA with more than 18 years of experience advising multinational Canadian firms on U.S. tax compliance, structuring, and market expansion strategies. Michael is a partner with KPMG's family office team with over 30 years of experience advising high net worth individuals and senior executives on complex U.S. and Canadian tax issues. He also serves as co-chair of the tax committee for AmCham Canada. Together, they will provide insights on how the One Big Beautiful Bill Act, OBA, creates incentives for Canadian companies to invest in the United States and what businesses should consider to maximize these opportunities. So with that, I'm going to hand it over to Michael and Namir.
Bradley, thank you so much for that great background on Select USA. Hey, the summit is a great event, and I encourage Canadians with an eye to the U.S. market to attend both the upcoming Toronto and next year's Washington, D.C. event. So hi, everyone, and welcome to today's Select USA Canada Conference special session on the One Big Beautiful Bill Act, or as some of us have now come to call it, OBBA. I know others are also calling it BBB. I'll try not to use ABBA, so as not to distract us with any Swedish pop music reference. I'm Namir Hallak, partner at Andersen. I lead our U.S. cross-border business tax practice. I'm also a member of American Chamber of Commerce, and I'm based here on the West Coast in beautiful Vancouver. And I'm joined by Michael Pereira, fellow member of AmCham Canada. Michael, I'll let you introduce yourself.
Yeah, hi everyone. Very glad to be here today and have this opportunity to present with Namir. As was mentioned, I'm a partner with KPMG and a board member with the AmCham Canada. Very proudly a part of that organization. I'm based out of a flatter part of Canada here in Toronto, Ontario. But looking forward to sharing details with all of you about the BBB. That's my typical acronym for it.
Well, look, whether you're a manufacturer or a tech founder or part of a family enterprise that's exploring U.S. opportunities, I think you're really here at a very pivotal moment. If you rewind back to 2017, the U.S. had passed what was known as the Tax Cuts and Jobs Act. And this was like a major reset for corporations and individual taxation. And, it lowered rates and introduced a lot of great business incentives, but they were temporary. So a lot of them were designed to start fading out by 2025, which meant, a lot of companies spent the last few years in the space that Michael and I work in, trying to make decisions with really one eye on that expiry date. So now you fast forward to this summer, July 4th to be exact, and the U.S. decided to lock in with a new direction, what's known again, the One Big Beautiful Bill Act, or OBBA. And this is essentially the sequel to the 2017 tax reform. But this time you had a lot more permanence that was baked in. So instead of saying, let's test it out and maybe renew it later, the US said, let's make these pro-investment rules the new normal. And, for Canadians, this really isn't just about lowering taxes. We really are seeing this as a clear, longer runway to plan your US expansion, investment, or succession with a lot more certainty. And that's really exciting. So that's where today's conversation comes in. Here's how we're going to run our chat, me and Michael. I'll have some questions for Michael. We're going to start with the big picture, what OBBA actually does for Canadians. Then we'll move through some of the major themes that have come up, like full expensing, innovation, small business relief, as well as some of the cross-border simplification. And then we'll switch roles. Michael will be asking me some questions on some of the Made in America credits, state-level considerations, deal strategies, and a few pitfalls, and hopefully we'll have some key takeaways for everybody. So let's set the stage with that and start with the big picture. My first question to you, Michael, is again with the One Big Beautiful Bill Act. Again, it's a landmark in U.S. tax policy, and it's already really reshaping the landscape for Canadian businesses and individuals looking south of the border. So what makes OBBA so significant for Canadians considering U.S. investment or expansion?
Yeah, thanks, Namir. And I think you really hit the nail on the head in terms of identifying that this bill is really largely focused on making the U.S. the destination of choice for business investment and expansion, right? So what they've done is, as you said, kind of take that 2017 Tax Jobs and Cuts Act and really fix on making the incentives both clear and easy to use and take advantage of, and most importantly make so many of these permanent, and so really to allow businesses with that confidence um, and predictability that they can make decisions right now, where businesses are often making decisions, that are going to span out for long periods of time when they're making particularly like, significant capital investments. They need to, factor in what it's going to look like over a 10 to 20-year horizon. And that has been a bit of a challenge with some of the provisions of the Tax Cut and Jobs Act, or even other aspects of the US Internal Revenue Code, where some things have actually been temporary for almost generations, I'll call it, and we'll get into that. But, they just continue to be rolled over, but there was always some degree of uncertainty with them. And so the benefit of now putting this, pen to paper essentially with this act is that we've got permanence and really just predictability and stability in decision making for businesses, looking to expand or operate in the U.S., for individuals that are looking to invest or potentially move to the U.S. Everything has become more permanent, and I think now allows everyone going forward to know what they're looking at and make proper decisions, and effective decisions when they're considering the U.S. market.
That's great, Michael. Yeah, I can imagine, for a lot of business owners, that certainty is key in trying to plan for next steps. And I think these incentives that are being available now with that permanence really does, fundamentally, essentially alter that after-tax return calculus that business owners are making for this cross-border investment. I'm going to make a small pivot here just to talk a little bit about individual Canadians first before we jump into more of the business side of things. So maybe walk me through, like, what are the key estate and gift tax changes, and how are these affecting Canadians with, U.S. property or family?
Yeah. Yeah, and let me step back quickly and just give um, a refresher, maybe for some people, on what these rules are. Because the U.S., what they have when someone passes away is that they have a an estate tax, and this is a little different from what we're used to in Canada, where we don't have any kind of estate or inheritance tax. We have a deemed disposition that arises on death, and gains are taxed. In the US, they tax assets. The value of assets are subject to a tax, and that could be up to a rate of 40%. Canadians are impacted as well, just because we live in Canada. If you are a Canadian that passes away owning US real estate, US stocks, any what we call US situs property, then you can also be subject to US estate tax. Americans have this exclusion amount, though, against their U.S. estate tax. And this is one that actually even has changed. The amount of exclusion has gone through a number of changes over the last couple of decades. And with the Tax Cuts and Jobs Act, it also went through a bit of a change in the sense that they kept high rates of an exclusion amount, but it was subject to a sunset clause. And so starting in 2026, without any new legislation, the exclusion amount, which right now for 2025 is 13.99 million, is going to go down to approximately 7 million. It's an inflation adjusted amount, so we didn't know exactly what that was going to be. But now under this act, the exclusion amount is going to effectively double and be 15 million. And now it's permanent. Like this is now a fixed permanent amount and it's adjusted index for inflation. So we don't have to, worry about in the future that, again, it may go down to a lower amount. The benefit for Canadians investing in the US, whether it's, corporations, public securities, real estate, is that under our Canada-US tax treaty, we get to benefit from this exclusion amount. There's a formula associated with it, but effectively, in simple terms, if a Canadian's net worth is below $15 million, or they're married and leaving their US assets to a spouse and net worth is below 30 million US dollars, they won't be subject to this tax. So now even Canadians have predictability in terms of planning for, hey, I own these US assets. How do I factor in US estate tax? For a number of Canadians, it kind of wipes out that from being an issue. And it just makes things then simpler for a whole host of Canadians that are in this position of owning US real estate and or US securities, and even investing in the US.
Yeah, because really, essentially for Canadians that are going to have, whether it's U.S. real estate, U.S. securities, or even family members in the U.S., what this higher exemption is meaning is that fewer could be subject to that U.S. estate tax, right? And for anybody who's considering a move, it's just going to be important for them to obviously coordinate U.S. and Canadian tax planning. But for now, the U.S. side is more favorable than it's been in decades.
Yeah, absolutely.
Now, let's jump into the business side of things. I know one of the biggest provisions that's been a headliner for a lot of us tax geeks that are looking at the cross-border space has been around this full expensing. So let's unpack some of those business incentives. Maybe, Michael, walk us through the full expensing provisions and why would they matter for Canadian companies?
Yeah, certainly. So, and this started actually with the Tax Cut and Jobs Act, where you know this 100 bonus deductions were permitted for when businesses are making purchases of qualified property, then they would essentially get an immediate write-off. But under that act, from the 2017 Act, that was temporary as well. And there was a phase out that started after 2022 to limit that ability to fully write off the amounts. Again, this, this BBB has reinstated that and now again made it permanent. So what we're talking about really here is full deduction for capital investments that are made in the US. Um, and this is significant, right? Like you're getting the full benefit of a deduction up front when you're making potentially significant capital investments into the US. It lowers your effective tax rate immediately from these purchases. It hence frees capital for future growth because you're getting the benefit of the tax deduction right away. And it really like helps match the money that businesses are putting in with the timing of the benefit of putting that in. If we make other, if we incur other expenses as a business, we ordinarily get to write that off right away, except historically capital property has always been something that we're forced to amortize and take deductions over multiple years, depending on the type of property, would dictate how long you get to how long you have to amortize that for. This immediate deductibility is, in my mind, not a phrase I like to use often, but the game changer is it's quite significant in terms of the impact of this type of tax provision. And again, when we compare this to Canada, where under the Canadian system of capital cost allowance, which is our version of depreciation for businesses, it is a year by year type of amortization and deduction. And so really it's, for many businesses looking at where am I going to, spend money on capital projects, it's causing them to tilt or, certainly look at the US much more substantially because of that um, you know, financial metric that they get immediately.
Yeah, I think you're absolutely right, Michael. I think for a Canadian business, this can tip the scales in favor of a U.S. expansion. Obviously, especially when you combine that with the U.S.'s large market and supply chain advantages.
Of course.
And with the full expensing, essentially, we're saying here that you get this front-loaded tax savings, you've got improved cash flow, even just how you're looking at the net present value of our U.S. investments. It really does make the United States arguably one of the most attractive G7 jurisdictions for these type of significant capital investments.
Yeah, agreed wholeheartedly.
Now, when we jump into what this, because we talked a bit about kind of these incentives for all businesses, larger businesses. I know some of the provisions in the OBBA isn't just for large corporations, right? So, how does the OBBA make U.S. expansion or investment easier or more affordable for the smaller Canadian companies?
Yeah. Yeah, no, for sure. It's not just something that's focused on the large multinationals, the big businesses that are, spending hundreds of millions of dollars on capital projects. There's always been this provision in the U.S. tax code that essentially provided for immediate deduction and just a very simplified approach to expensing capital um, purchases um, that has been available for a long time. But what under this act they're saying, and they're acknowledging that this is still a very important part of the business environment in the U.S., right? Like whether it's we acknowledge it as part of a significant aspect of Canadian business is our small businesses, but it's true in the U.S. as well, that small business drives the economy. And so they're not neglecting that. And in fact, they're saying, we're bumping those limits up just in terms of this very easy and efficient process for taking these deductions. So historically, it's been capped at $1 million, and now they've raised that to 2.5 million. There are phase outs as the businesses grow. So clearly, again, targeted for small businesses as they become more successful and have higher revenue, start to see those phase outs. But again, it's just a simplified method that exists in the US to give businesses easy return on capital. And so I'm glad to see that the US are acknowledging that market as well.
Yeah, I can imagine if you're a Canadian entrepreneur, whether it's running a U.S. franchise or let's say mid-sized manufacturer, this is a key driver for them. It's going to simplify, as you said, the tax compliance and really just accelerating that payback period for their U.S. investment.
Yeah, for sure.
Now let's jump into another big headliner from OBBA, and that's around how it changes those in the R&D space or tech space. So, walk me through what is the new rule on U.S. R&D spending, and what does it mean for Canadian tech firms or AI firms that are in that space with these kind of R&D spends?
Yeah. And this is one of those areas, in fact, that goes historically in terms of this being a constant temporary part of the tax code in the US that constantly had to be renewed by Congress. And thankfully now they've made it permanent. But even beyond making it permanent, what they've done is make R&D expenditures that are incurred in the US, available for immediate expensing. And that's huge for, both startups and even, businesses that are doing well and maturing, but still spending the money in development and research, because again, that return on investment is immediate from a tax perspective. And, when you think of the tech firms, the AI firms, which is a huge area of growth in the U.S. software development, all this research involved in technology and the work that they're doing. It's part of that definition of research and development and qualifies for this immediate expensing. And the key to highlight here, Namir, is this is focused again. The purpose of the bill is to make the U.S. the destination of choice. This is something that is specific to the U.S. market. For businesses that are, U.S. businesses that have foreign research and development, that didn't change. They have to capitalize and amortize those expenses over a 15-year period. So really, the attraction there is for that R&D work to be done in the U.S. When you stack in a credit that's available as well, on top of the expensing, it's quite an advantageous area for businesses to be spending money now in the U.S.
It really is. It's a major win for I would say innovation-driven businesses. Especially if you have a Canadian tech firm that has U.S. operations. I was talking last week with a BC firm here. They're actually a biotech firm with a U.S. subsidiary, and they were doing these clinical trials and product development. And funny enough, for them, the way it's worked out is they were looking at $5 million of R&D expenses prior to this in the U.S. And that would have taken them 5 years under the old rules to recover.
Yeah.
And now, based on what you walked us through, this is essentially a deduction that they can take year one and generating losses for them that they can carry forward. So that's an immediate deduction. And then you've got on top of it, as you said, you can stack that with the R&D credits. So it really does make the U.S. quite the preferred location on this type of new research projects, especially for companies weighing where are they going to do that type of R&D work. U.S., Canada, European countries. I think that's an important factor and driver in this space.
Right. Yeah.
Now, I want to shift focus a little bit into international tax. So there has been a lot of headaches here for Canadian companies when they have U.S. or global operations, and part of this is dealing with the complexity that comes with U.S. ownership, attribution rules. Walk me through how does the OBBA make life simpler or maybe more predictable for Canadian companies that are now running cross-border operations? What has changed for them?
Yeah, for sure. And I think to highlight your point, it's simplification and predictability for businesses. I think it's important for us as Canadians and Canadian businesses to understand what they're up against, right? Because a lot of this, from an international tax perspective, is focused on U.S. companies doing business outside of the U.S. But so how do we stack up, and how do we compete with them? And so, for example, one of these rules that this was introduced in again, part of the Tax Cuts and Jobs Act of 2017 was this foreign source intangible income. And really, this was created and designed to encourage U.S. businesses to sell goods and services outside of the U.S. by providing a lower rate of tax on that kind of income. But it came with certain stipulations and complexities around how you compute that income and the deductions you had to take against that income. And even then, when it was first introduced, it was at a rate of 13.125%. But then it was going up to over 16% after 25%. So its effectiveness or attractiveness was not as significant after 2025 when you compare it to a federal rate of 21%. This bill, as an example, it streamlined the kind of types of deductions that you're taking and got rid of some of those deductions, and have now fixed the rate at just under 14% for this type of income. So again, when you're thinking about U.S. businesses and competition in that way, they've made it more attractive for U.S. businesses. Same thing, they had this regime of what we call GILTI. It's global intangible low tax income. And what this did was force US companies that had foreign corporations outside of the US that earned, active business income. It forced them to take into their own income from a US perspective the net earnings of these foreign businesses. Um, and so those, it used to be taxed at a 10.5% rate, but that also was going up, after 2025. And again, had complex rules around, how you computed that income and computed the effective rate, and even what foreign tax credit you got for the taxes paid in the foreign jurisdiction. So it used to be limited to 80%. They've now increased that to 90%. They've simplified the deductions, and how you now determine income, and again fixed the rate. So again, they've made it a lot simpler. And finally, the 2017 Act, introduced, I think inadvertently, some complexity around, what kind of foreign companies were caught as these, controlled foreign corporations subject to all these complex rules. And they have now fixed that. So it used to be that companies that were not controlled by US people could still be, caught under these rules. They have now finally fixed that and restored it to these old rules, which again just provides the US individuals and US businesses with a lot more simplification in terms of dealing with complex, cross-border rules.
Thanks for that. Yeah, I think this has been, one of the areas that, if you have a multinational corporation, there's always been this risk of whether there's going to be double taxation, or how you're going to be caught by this regime. So I think this does make the U.S. system a lot more competitive internationally. We got a question. I'm just going to read it here real quick. Just read the Q&A that just came in. Looking to expand our manufacturing in Canada by buying a similar manufacturing business, hopefully by purchasing out a business at a retirement stage or looking for a majority partner. We don't have the time or skill to start from scratch, so by buyout, we have a U.S. business operating according to their rules and regs, and have a skill set of employees. Any risk doing this and/or incentives? Just kind of a high-level overview. You want to make sure you're looking at what's going to be the right structure for doing this acquisition. You want to manage, obviously, both the tax and legal risks. I don't know if the question there is around whether there's going to be an asset purchase, but that would also have non-tax factors to look at. But I would say the one recommendation, two recommendations I would say to that question is, you'd want to model what your after-tax cash flow looks like, including kind of the US and Canadian taxes and credits, and definitely work with a cross-border tax advisor, because you don't want to be looking at this silo just from a US perspective or a Canadian perspective. Hopefully you can step back and look at what's the big picture for exit strategy, and hopefully an efficient structure for your cross-border business.
Yeah.
All right.
Good point to plan ahead, right? Like make sure you're doing it right up front.
It's always much easier to get it right from the get-go than trying to clean up. It's usually when it lands on me and Michael's desk to clean up, it's a lot harder.
That's right. More expensive.
That's right. All right, Michael. I am with that. I think we're switching roles here.
Yeah, absolutely. Yeah, looking forward to asking you now some questions. So these Made in America credits that were, introduced as part of the OBBBA, give us maybe some examples, or how do these credits work? What qualifies, and how do Canadian businesses, what do they need to do so that they also benefit from these type of credits?
Yeah, I would say this is really where the rubber hits the road. What actually qualifies? How can Canadians play in it? You've got what's known as the Advanced Manufacturing Investment Credit, and this is a big one. But again, it's very niche. What BBA did is it amended what was previously a 25% credit, and it cranked it up to 35%. And that's for eligible investments, including tangible property, buildings, structural components, But this credit is really aimed squarely at those that are primarily manufacturing semiconductors or semiconductor manufacturing equipment. So really the kind of supply chains that we know Washington wants to anchor back in North America. But look, for Canadians, that 35% is a dollar for dollar federal tax credit. So, you're looking at a reduction in your U.S. tax liability. So if you had let's say, $100 million project and you're looking at a $35 million credit, that's even before you factor in depreciation or expensing. So, your after-tax cost of a U.S. bill does drop dramatically as a result. The other, again, but that's very niche. Like I said, it's for the semiconductor equipment manufacturing facilities that qualify. Now, the other one that's caught a lot of people's attention as well is new legislation for 100% expensing for the production portion of any non-residential property. So it has to be part of a factory building that's used in production activities. So not just the equipment inside. And I know we're going to touch on that a little bit later as well. But really what this means is, if you're constructing, let's say, a $50 million plant and $40 million of that space is used for production, that $40 million can be written off in year one. At the US federal 21% rate, that's about an $8 million plus immediate tax saving. And you still get to layer the manufacturing credit on top of that. Now, when you put those two together, you're suddenly turning what used to be a 4-decade recovery on your cost into this 1-year return on investment story. And so I think we're seeing a lot of shifts in the conversations around site selection, modeling, companies looking for US site selection that can really deliver a 15 to 20% stronger after-tax return. And I would say for Canadians, the strategy here when you're talking to your cross-border tax advisors is how can you model your stack? You're looking at this, if the 35% credit is eligible for you, are you eligible for those immediate expensing for your equipment, or again, if you have a production portion of your building? And then, of course, the next step is looking at which states conform to those federal provisions. But there can be significant savings here for entities that are looking to model how they can invest in these manufacturing or other spaces with these credits.
Yeah, no, that's amazing. And I think, I think we all saw that there was emphasis placed on returning manufacturing and, business operations to the US. And I think what this is showing is that they're going to put the necessary, credits and structure in place to make sure that happens. And this is the kind of thing that demonstrates that. And so I think you touched on this a little bit, but yeah, maybe like what are some of the, particulars on this, building and this ability to deduct construction costs in the US up front?
Well, look, I think this is, one of the biggest, again, I keep using the word game changers under the One Big Beautiful Bill, because what it does is for the buildings, not just the machinery inside of them. So previously, if you had, built or bought a factory in the United States, you had to depreciate the cost of that building over 39 years, a pretty painfully slow recovery of that significant investment. Under this brand new provision, a Canadian company that is investing in a U.S. facility and that building is used for what we call, qualified production activities, and that can be manufacturing, processing, refining. You can deduct the full cost of that production portion of that building in the very first year it's placed in service, and that's a pretty huge shift. Again, this doesn't involve any areas that are not directly involved in the production. So if you have spaces for office, administrative area, parking, sales, retail functions, those are generally going to be excluded, and they'll still follow the regular slow depreciation rates. But again, for a Canadian company looking to expand to the U.S., this means you can potentially write off, a significant cost of your new production facility right up front. And if you can stack with the advanced manufacturing credit, that's a pretty significant overall tax reduction. And you can see how that type of difference is an important factor when you're looking at whether you're building in Canada or looking at a US tax state. Now, this isn't just a tax benefit on paper too, right? Like this immediate deduction, it'll improve your cash flow. It'll increase your, internal rate of return, and it'll also make it easier to secure financing. If you're looking at like we talked about,
Yeah.
the $40 million investment in a qualifying activity, that's generating over $8 million in federal tax savings in the first year alone, before even considering any state level benefits, which we'll talk about as well later. And this kind of upfront savings really can make your project more attractive to banks and investors, and does it can tip the scales in favor of a U.S. location. And banks and investors notice that. It's a faster payback and better debt capacity. It all feeds into the valuation and project viability. So I think, for a Canadian manufacturer, the OBBA has really turned this, 39-year deduction into a 1-year write-off for these new U.S. production facilities. And I think it changes the economics of where you want to build your next plant, and makes the U.S. a much more attractive option from a tax and a cash flow perspective, and changes how I think a lot of our Canadian clients are looking at where to build next.
Y- Yeah, and I think what it highlights as well, is how important it is to make sure that, because as you highlighted, like if you're building, a plant, but you have other, construction costs outside, the parking, the things like that, making sure that you're properly tracking costs, that you get, segregate, you're segregating the costs properly, sometimes getting professionals to help you do that kind of breakdown so that it gets allocated properly, and that you can really maximize, the expense, the ability to expense as much right up front as possible.
Right.
And so, yeah, I mean, we've been focusing a lot on, at the federal level, what these benefits are that are available to businesses investing in the U.S. But to drill down, I guess, more, the U.S. is a big country, and unlike Canada with our 10 provinces and 3 territories, they've got 50 states. And so that adds another layer of complexity of, okay, I want to do business in the US and I understand the federal rules, but uh, how do you think about when, states, when you're helping businesses make the decision to invest in the US?
Well, Michael, I think, picking the state is a key decision factor for companies looking south of the border. First off, it's important to, understand that, the OBBA does create this uniform set of federal tax incentives, like we talked about, the full expensing, whether it's for equipment or certain production property. But how those benefits are going to play out at the state level uh, is really anything but uniform. So the state you choose can have a significant impact on your after-tax return, potentially making or breaking the economics of a project. And here's why. Roughly, I would say half of the U.S. states, so I think it's around 26, they use what's called rolling conformity. And so what that means is they are automatically updating their tax codes to match the latest federal internal revenue code. So if you're investing, for example, in a rolling conformity state, you get the full benefit of these, new federal deductions and expensing rules right away, including the OBBA's, full expensing provisions. On the other hand, you've got certain states that are static conformity states, like California is one of them, who will only update their tax codes when the state legislator essentially passes a new law. So if you're, for example, looking at a static conformity state, you might have to wait months or maybe potentially even years before you can claim these new federal deductions at the state level. So part of making sure you're looking at these different states is understanding where does it lie, and what's the state that is going to give you more certainty, and how that plays out for your overall business plan. Now I know, Michael, you discussed the Section 179 small business expensing,
Yeah.
when OBBA raised their federal limit to, I think it's 2.5 million to the 4 million phase out. Now, most states conform to this, but it's important to also note, even with a provision like that, there's roughly, again, I think 12 states that have their own lower caps, so they don't automatically adopt this higher federal limit. So again, if you're a small or mid-sized business, this can mean a potentially much smaller deduction at the state level, again, which can affect your overall tax position. So tax conformity is a start. Obviously, many states offer additional incentives, property tax abatements. There's the job creation credits, workforce training grants, and so forth. Some of those are statutory, so they're available to anyone who qualifies, and others are negotiated directly with state or local agencies. So I think there has to be an overall review and modeling this out to see how these incentives work at the federal level, how do they stack to the federal benefits, and in some cases, there might be some combined value that can swing your effective tax rate by several percentage points, depending on which state you are looking at.
Yeah, I know you're right. It's such an important consideration, and I see this even on the individual level. Like what it's obviously there are multiple factors that go into making a decision on what state to invest in, to live in, to set up your business. But getting all the right advice on all those components is so important, and tax is clearly a major driver of that.
And state or local tax is an important lens that you need to have as a Canadian business. We sometimes, I find a lot of Canadian business owners, it's overlooked because they're focused on kind of the federal tax side of things and the federal
Right.
benefits. But the state and local tax can have as significant, if sometimes more significant, of a driver in the overall equation of your expansion to the U.S.
Yeah, definitely. And so for Canadians buying US companies, like how are these incentives, these tax changes, everything in the big beautiful bill, how is that improving deal value? What are you seeing in that respect?
Well, look, I think, I think the OBBA is really fundamentally changing the deal math. Again, it's changing how we're looking at the value, finance, and even structuring acquisitions. So I'll start off, with one of the immediate impacts. For number one, I think buyers can expense a lot of those post-acquisition capital improvements right away. So, for example, when we're looking at with these new rules, most capital improvements, as you had walked us through, if they're made after the deal, like equipment purchases, let's say plant renovations, facility expansions, they can now be, fully deducted in the year that they're placed in service, as long as, of course, they meet the eligibility requirements. So, for a Canadian corporate or private equity buyer, it means you can potentially pay a higher purchase price, maybe invest in modernization, after the closing, and still preserve your target after tax return. The other provision you talked about, the immediate expensing, also, it shortens the payback period, improves your after-tax cash flow, and makes integration or these type of turnaround deals a lot more attractive. And, the same principle applies for, M&A, any mergers and acquisitions. This type of immediate expensing of eligible assets can also, again, enhance affordability and support stronger valuations. The other thing I want to touch on, because you mentioned this, and I think it's a good thread for looking at deals, Michael, is beyond the deductions. I think the second major benefit that we see in this space really goes to predictability. You know, OBBA really locks in this permanent expensing for most qualified property, expanded and modified a lot of business credits, simplified, as you mentioned, the international tax rules, and for years, temporary provisions really made the modeling quite uncertain, right? Investors had to guess whether these incentives would still exist in 5 years later. So I would say that uncertainty prior to OBBA created what we would call almost like a policy discount, right? Buyers are building in this extra risk because Congress could always move the goalposts. But I think the rules now have given us predictable factors enough to at least model it out. So you can run a 10-year forecast and trust the tax base and price a deal accordingly. And I think I think lenders really appreciate that stability. It makes financing more straightforward, it evaluations more reliable, and hopefully the underwriting cleaner. And I would say one last thing on the deals space here is one of the last changes, really, that one that sometimes flies under the radar is just an overall improved foreign tax credit system. I think, you know, what OBBA is doing here is raising the percentage of foreign taxes that can be claimed as a credit. So eliminating some of the allocation requirements that used to chip away at your credit pool. So again, for a Canadian looking to acquire a US company, you know, this means potentially less risk of double taxation on profits you're repatriating back, and hopefully a more straightforward kind of global integration of that U.S. company that it, if it later invests abroad. So, you know, I think credit utilization, less leakage, and hopefully smooth cash repatriation. I think we're seeing in the mid-market space a lot more of the, you know, deal momentum rising as a result.
Yeah. Yeah, no, and I think that's, touching on that, the simplification and that predictability just really impacts, you know, at all levels, the businesses, the creditors, really wanting to go into the US market and being able to really lock in on a more long-term basis what these values are going to look like, and being able to predict the future much more better.
Yeah, I would say the OBBA really does improve both, you know, the entry economics, you know, and the exit value for Canadian investors.
Yeah, absolutely. And so, always important with any legislation is the potential pitfalls. With everything that is good in this act, is there anything that businesses need to be mindful of, and watchful of, or avoid, when thinking about doing business in the U.S.?
Like, you know, for Canadians wanting to, you know, capture a lot of these benefits, you know, you still have to pay close attention to the details. One which is probably not a big surprise here is just on, for example, documentation. You know, if you're looking to qualify for the full expensing, you know, make sure you've got the documentation to show, you know, when was a property placed in service, how is it being used, making sure it's meeting the criteria for, you know, these type of incentives, things like purchase contracts, cost breakdowns, all these things, when the assets go live, all these factors matter. You know, if you're using, for example, the facility that's part factory, part office, you know, just be careful, because again, only the production portion qualifies. And the IRS does have a history of, you know, challenging those type of allocations. So, you know, treat this as an audit sensitive area, and, you know, keep your records organized and up to date. The other one is just an important reminder on the, you know, change for the R&D deduction. This immediate expensing that Michael, you walked us through, only applies to research done in the US. So the new rules let you immediately deduct those US based research costs, but only if your R&D, but if your R&D is happening in Canada or elsewhere, you still have to spread those deductions out over many years. So again, if innovation is a big part of your business, where you do your research really matters. And sometimes, you know, moving a pilot program or development teams in the US could unlock, you know, some of those immediate deductions, and make you eligible for additional credits. Third one, which we touched on, is, you know, watch for those state level differences. Not all US states follow the federal tax rules in the same way. Some of them adopted right away, others lag behind, and some of them don't adopt them at all. So just be aware of those differences. And just kind of a final note, but it's actually a critical one. It's, you know, cross-border coordination is key. What might look really great from a US tax benefit on paper could create issues if it doesn't line up with the Canadian tax treatment. So, you know, whether you're structuring an entity, planning a project, or making an acquisition, you know, the rules the same. Model it out from a cross-border perspective. Make sure the US benefits you're claiming don't come at the expense of Canadian tax efficiency or compliance or exit strategy. You know, in Canada, we have the long-term capital gain exemptions. So you just have to be aware that it's not tripping up on those as well. Anytime, you know, for example, the US expensing some of these accelerated deductions, Canada may recognize the income differently. There could be some timing mismatches, or it could affect your surplus calculation. So, you know, Canadian companies should also keep an eye on their foreign tax credit pools, and, you know, make sure their US and Canadian tax planning are working together. And, you know, for individuals, especially cross-border executives or shareholders, the estate and reporting rules need to be harmonized, so you can avoid surprises or double taxation. So keep your documentation tight, know where your R&D lives, confirm your state rules, and coordinate across borders.
All great, all great things to be mindful of, especially in the cross-border space, for sure. Making sure that you're on top of things on both sides of the border. Don't ever assume that there's a consistency and congruency in respect of the rules. And just in terms of some final takeaways, what I wanted to highlight for everyone was, we clearly focused on some of the major aspects of the bill that really are, significant to Canadian businesses, looking to invest in the US and thinking about where are they going to, put their capital. But, I think there's lots of other aspects of this bill that are really, going back to the theme of, simplification and predictability that we didn't even touch on. This bill is designed to make doing business in the US simpler and more advantageous from a tax perspective. And I think, in terms of takeaways, that's for me, one of the major takeaways is that, doing business in the US has become a lot easier, and tax is always an area of complexity and risk, but certainly attempts have been made to try to make that more straightforward for everyone, and in a way that makes it more valuable for businesses, that there's actual tangible takeaways from that in terms of operating their business and getting benefits for the money that they're spending from a tax perspective. I don't know, Namir, if you had any other thoughts that you wanted to add in terms of final takeaways.
That's a great summary, Michael. I think, look, the OBBA, I think the United States is sending a clear signal. It wants capital, it wants innovation, and it's willing to pay for it. You've got that permanent expensing, manufacturing credits, expanded estate and investment incentives. Washington is effectively funding this inbound investments. And the message from the US is simple: bring your ideas, bring your capital, bring your talent, and they'll help you grow it there. I think the OBBA isn't just a tax bill. I think it's a roadmap for expansion, and hopefully Canadians will look at this as a way to extend their operations, their investments, and hopefully their influence southward. I think it's a structural, long-term invitation for Canadians to participate in the next wave of U.S. growth. I know we're at our time here.
Yeah.
So we'll look at some of the. I know we answered one question earlier. I've got a few more that have come in here. I think I'll read this one. Just give me a second here. So one question here was, are there any changes in the OBBA that affect the eligibility of Canadian investors or companies for U.S. green energy tax credits? I can touch on this real quick. I don't know if Michael, if you want to add to it, but I'll start here. So I think this is also a significant development. The OBBA, it did accelerate the phase out of a lot of green energy tax credits. Those are for clean vehicles, renewable energy production, investment in wind and solar. But really what's important here for Canadian investors is that the law does introduce some new restrictions. So you need to be looking at credits like the manufacturing production credit, clean energy production credit, and there's also the investment credit. And a lot of those are going to be denied to specified foreign entities or foreign influence entities. So that doesn't mean Canadian companies are not eligible. It just need to look at the eligibility requirements, because it can include Canadian-owned companies as long as they meet certain ownership or control thresholds.
Yeah, Great question to address. One other quick question I'll just take is, is this bill more advantageous for foreign investors that are new into the U.S. market, um, compared to foreign businesses that have already been in the U.S. for some time? And I think, I'll start with that answer. Um, Businesses in the US, whether they are mature or, startups, can take advantage of these significant, tax provisions, that whether, and whether foreign or US domestic, these are provisions that are advantageous to all businesses. It certainly incentivizes new businesses to come into the US and establish operations in the US. But it's always also very much an incentive for existing businesses, whether subsidiaries of foreign companies, foreign parents, or U.S. domestic entities, to expand or continue their business in the U.S. as opposed to looking elsewhere. So I think it really benefits all businesses, small or large, foreign or domestic, mature or new, and even across industries, definitely very advantageous for businesses like, tech, AI. The R&D expenses that we talked about earlier is significant, but everyone has the ability to take advantage.
Thanks, Michael, for that. I've got another question here. Are there any particular industries that are expected to benefit most significantly from this bill? I'll answer kind of on that one. So I think, the biggest winners here really are going to be those capital-intensive manufacturers, so tech and pharma companies with, significant R&D budgets. Any U.S.-controlled clean energy developers, startups and small business, like we talked about earlier, they also get a boost, especially with that expanded small business stock exclusion. But the common thread is, the more you can localize your operations using U.S. labor, U.S. materials, U.S. ownership, I think, the more you stand to benefit. And if you're potentially in an industry that meets those requirements, you may find yourself left out of most of those generous incentives. So something to look at. But I think, the new rules could be a change in the equation for Canadians looking to invest. There are opportunities. Of course, there are hurdles too. But, I would say plan ahead, structure your investments carefully, and make sure your supply chain and ownership meet the standards for a lot of the incentives that are being available with OPVA. Do we have time for one more question, Michael? If you want to take the next one.
I think we have one more time for one more question. Yeah, for sure. Yeah, I can take this one. So, does this bill include any America First or localization requirements that impact, ownership structures or supply chains? And I think, the primary takeaway in terms of the requirements that this bill has is it's doing business in the U.S. And its expansion in the U.S. So it's capital property purchased in the U.S., non-residential buildings built in the U.S., um, research and development done in the U.S. And that is where the enhanced deductions and in some instances credits that we talked about are available. And so in terms of, ownership structure, I think there is flexibility there. Of course, I think that's a bigger question about what is the overall structure and what makes sense from a both, tax and legal perspective. And then it impacts supply chains in the sense that a lot of businesses, I think, looking to take advantage of these provisions of the tax bill as well, are going to be looking at, supply chains directly. And others are going to be setting up in the U.S. to be part of the supply chain directly in the U.S. But I think, the key takeaway is it's doing business in the US and spending putting your capital in the US. And, structuring is it's important to get that cross-border advice in terms of what makes sense in terms of, legal structure, business structure, things of that nature. But irrespective of that structure, the deductions are available.
Yeah, and you're essentially making sure that you're looking at your ownership structure as well as your supply chain. I think the ownership structure and supply chain are going to be key factors in how you're getting access to that as well. All right, I guess with that, we're at our time. Michael, thank you very much for joining me for today's walkthrough of OBBA.